It's Thomas from Curvo. So there's been a recent change to the TOB rate in Belgium, also known as the beurstaks or taxe boursière or the Belgian transaction tax, specifically on VWCE, where the tax has risen from 0.12% to 1.32%. So this 11-fold increase obviously has implications on the cost of investing in VWCE. But how do we actually calculate its impact? And what alternatives are there to VWCE? So we're going to answer these questions in this video for you. So the broker Bolero surprised everyone when they increased the TOB rate of VWCE to 1.32% in July 2021. It's much higher than the 0.12% rate that other brokers in Belgium were still charging. It seems like all brokers are going to have to follow according to the Vlaamse Federatie van Beleggers, the VFB. The Belgian taxman used to consider the distributing and the accumulating variance of a same fund as actually separate. So the TOB was 0.12% as long as an accumulating fund wasn't registered in Belgium, even if its distributing variant was. With the change, the tax authorities decided that the accumulating and distributing versions of the fund are actually the same. And if the distributing version of a fund is registered in Belgium, it actually considers the accumulating version registered in Belgium too. So VWCE is accumulating and it's not registered in Belgium. Its distributing variant, the VWRL, is registered in Belgium. Are you confused? Well, you'll see, because with the change, that means VWCE is now considered registered in Belgium, causing the jump in TOB from 0.12% to 1.32%. So what does the actual TOB increase mean for your return? So the increase in TOB affects your investments in two ways. While you invest during the accumulation period of your life, and secondly, at the very end of your investment journey, when you actually sell your investments to live off the money. So we calculated the impact if you were to buy 200 euros of VWCE every month for the next 20 years. So the monthly contribution of 200 euros, if there's no tax, the portfolio value will rise up to 132,103 euros. That's an annual return of 5.17%. If the tax is 0.12%, the portfolio value jumps to 131,787 euros and the annual return is 5.16%. Now, if the tax is 1.32%, the portfolio value is less. It's at 128,639 euros, and that's a return of 5.03%. Please note that you can find the calculations for the results. We put it into the show notes, so just copy that Google Sheet, make a copy for yourself, and you can change all the parameters to kind of suit your situation, how you actually invest. So you can see that the 0.12% transaction tax only has a small effect on the return. However, the 1.32% tax rate reduces the average annual return by 0.13%. That's quite significant. So every month, the higher tax reduces the amount of VWCE that you can actually buy. So that difference compounds and becomes significant over time. So for this reason, we're going to look at some alternatives for VWCE. So considering the additional costs of investing in VWCE, we would like to know, are there any alternatives out there? We found two options for the Belgian index investor. So the first one is IWA plus EMIM by iShares. So this combination is equivalent to VWCE when weighted in the right proportions. So VWCE tracks the FTSE or World Index, which is composed of the FTSE Developed Markets Index and the FTSE Emerging Markets Index. IWDA, which tracks MSCI World, covers the developed markets. On the other hand, EMIM tracks MSCI Emerging Markets IMI, which is an alternative to FTSE Emerging Markets. So within VWCE, the stocks in developed markets make up about 90% of the fund, and the remaining 10% is invested in equities from emerging markets. Because the weighting is done by market cap, it makes sense to follow the same weighting for IWA and EMIM, so 90% for IWDA and the rest in EMIM. Note that the ratio changes over time, so it's something that you have to keep an eye on throughout your investment journey and make sure it's balanced. A positive thing about this combination, though, is that it provides a higher diversification because combined the indexes consist of 4,789 companies compared to the 4,100 which the VWCE tracks. Another difference is that the EMIM includes small cap stocks from emerging markets, whereas VWCE includes only large cap and mid cap companies. That's another small diversification benefit from actually switching. On the other hand, IWA plus EMIM is more costly than VWCE when it comes to broker fees. After all, you'll have to make an additional transaction with each transaction that you buy and sell. So furthermore, two funds are slightly more cumbersome also to manage than one fund. For instance, it's more complicated to calculate how many shares of each that you actually need to buy with each investment round, while also respecting the weighting in your portfolio. So the simplicity of a single ETF is much more attractive. The following chart shows that there's actually very little difference in performance between VWCE and the IWDA EMIM combination. This is not surprising considering their indexes are actually so similar. If we had invested 10,000 euros in 2005, both strategies would have resulted in about 42,500 euros today. The average return has been around 9.2% per year. So the other option that I want to share with you and for Belgian passive investors is to invest through Curvo. So in particular, Curvo's growth portfolio has really similar diversification as VWCE. It's composed of two funds, both offered by Vanguard. The first fund tracks the FTSE Developed All Cap Choice Index. Put the ISIN code just there if you want to go check it out. And a fund tracking the FTSE Emerging All Cap Choice Index. There's the ISIN code right there for you. And so this combination is very similar to the FTSE All World, the index that VWCE tracks. The indexes in Curvo Growth include small cap companies, which VWCE actually excludes. So as a consequence, Curvo Growth consists of 8,102 companies, which is almost twice as much as the 4,100, the number of companies which are actually in VWCE. So the two funds in Curvo Growth are sustainable. Why did I say sustainable like that? It's because investing sustainably is still challenging because everyone has different beliefs and values. They do focus on one guiding principle though. They don't support companies that are considered destructive to the planet. So concretely, this means that the following sectors are excluded. Non-renewable energy, I'm talking about nuclear or fossil fuels, vice products, so I'm talking about adult entertainment, gambling, tobacco, weapons, that's another one, so obviously civilian firearms, military weapons, and controversies. So these are companies that actually don't meet the labor, human rights, environmental, and anti-corruption standards which are defined by the United Nations goals. So one bonus is that the TOB is not applicable for the funds used in Curvo's portfolios. So the transaction tax is completely irrelevant. So Curvo works also with fractional shares. This means that all your money is invested. So when you're actually buying your ETFs, you're required to buy whole units of shares. For instance, with VWCE, it just crossed the €100 price per share point. So realistically, this means that if you invest €100 per month, you won't actually be able to buy the VWCE the first month. You're going to have to wait until the second month to buy your first share, and then you're left with a relatively large portion of cash that is actually not working for you. So the price of using Curvo is likely more expensive than buying ETFs through a broker. It costs 1% all in for the service on your total investments. This provides you with peace of mind as rebalancing is obviously taken care of and fractional shares are used, which means that every euro that you send to your portfolio is invested. And you can set up a direct debit to send contributions monthly and really put your investments on autopilot. So the past performance of Curvo Growth has honestly been very similar to VWCE, as you can see in this graph. Curvo Growth has seen a slightly higher average return at 9.4% per year, but that is nothing significant. The chart clearly shows that both portfolios behave very similarly. To conclude, with decisions like this, it's important to actually understand the cost linked to switching investment strategy, especially when considering broker fees. The change in tax rate for buying and selling has made some reconsider whether they should actually stick with VWCE, and even questioning whether it makes sense to have accumulating or distributing funds in their portfolio. We're still fortunate in Belgium that capital gains for stocks are not taxed. And from our analysis, you can tell that the 1.32% TOB rate does make a difference when you're buying and selling. For this reason alone, it's definitely worth considering one of the two alternatives that we've laid out and highlighted in this video. The first one is more of the do-it-yourself approach of EMIM plus IWDA, or the second where you use an app like Curvo that takes away all the work from your hands. Anyway, thanks for watching the video. Click subscribe if you want to see more updates, and I look forward to seeing you soon. Cheers.